Hello guys, welcome to another video. In this video, we are going to talk about variable costing, which is also called marginal costing. Guys, this is going to be a second video on costing. In the first video, we have already talked about basic definitions, but I will provide you the link of that video in the description of this video. But in this video, we have to quickly repeat few definitions in order to understand the variable costing. Guys, the total cost of the factory we can divide into two category. One is called production cost and second is called non-production cost. And production cost further can be classified either as direct material cost or direct labor cost or factory overhead. Okay, and non-production cost can be classified as selling cost or administration cost. Guys, actually for the material, we, if you remember last time we discussed, we have two types of material. One is called direct and second is called indirect. So what is the direct material? Direct material means that these are those tangible input to the manufacturing process that can practically be traced to the product. Okay, like which is, you can say these are those costs, the cost of the material which is identifiable, like the material you can identify, it is the major part of the product and it has major cost. Okay guys, for example, the sheet metal together for a piece of heavy equipment, the sheet metal itself are direct material. Then we have an indirect material. Guys, indirect materials are, again, these are tangible inputs to the manufacturing process, like these are tangible but that cannot be practically traced to the product. For example, welding compound used to put together a piece of heavy equipment, the welding compound is the indirect material. Okay, then guys, we have here labor cost. Labor can also be classified as direct or indirect. So what is the direct labor cost? Direct labor cost is the cost of human labor that can practically be traced to the product. Example, the wages of the welder, that is called direct. And what is the indirect labor cost? Indirect labor cost is the cost of human connected with the manufacturing process but that cannot practically be traced to the product. Or I mean, so these are those people, they are not directly altering the product into the finished goods. Okay, and it might include supervisor, foreman, or above level, even janitorial staff. So these are called your indirect. Okay, then third word, we have a manufacturing overhead. Guys, these overheads include three things, because overheads cost is also called indirect cost, because these costs cannot be traced into the cost object. And these costs might include what three categories? It might include indirect material, it might include indirect labor, and factory operating cost. As I told you, indirect labor and indirect material, these are going to be the part of overheads. Okay, and operating costs are what, the factory operating cost, also known as general overhead, and it might include utilities, real estate taxes, insurance, depreciation on factory plant, even rent, etc. So these are called what? Overhead cost. Okay, in simple words, we can say overhead costs are those costs which are not direct material nor direct labor. So those are called factory overhead cost. Then guys, we have a non-production cost. In non-production cost, we have a selling cost. Selling or marketing expenses are those costs incurred in getting the product from the factory to the consumer. Like you are incurring the cost, okay, to take the product from the factory and you want to deliver to the consumer. Whatever cost you will incur, that is called selling or marketing expenses. It might include sale personnel salaries, advertising expense, and product transportation. Not transportation in, transportation out. Transportation in will be the part of material cost. Okay guys, then we have here administration cost. Administration costs are those costs incurred by a company not directly related to producing or marketing the product. Like it is not relevant directly to the production nor to the marketing. Example, executive salaries, depreciation of headquarter building, not the factory building. Okay, depreciation of factory will be the part of overhead. Okay, so it's a headquarter building. And rent on warehouse containing inventory, because warehouse is not the part of factory, I mean to say, there we are not producing the product, there just we are storing the product. So that is called your administration kind of cost. Then guys, if you look at here, I told you last time also in the last video, direct material cost is treated as variable cost, labor cost is also treated as variable, and in the factory overhead you could have variable cost or fixed cost. Okay, like indirect material and indirect labor is the variable, and rent extra is the fixed cost. Same way, selling cost could be variable or could be fixed. Like salesman commission or distribution cost might be variable, salesman salary might be fixed, and administration cost, mostly these are fixed cost. Okay guys, now here just let me quickly remind you also, guys, variable cost, okay, are those costs which will change with the level of activity. Like if you will increase the production, these costs will increase. If you will decrease the production, these costs will decrease. And examples might include direct material cost, direct labor cost, even material and labor in general. Okay guys, so here first you need to understand variable cost in total. Variable cost in total, it vary directly and proportionally with the change in volume. Like if you will, I'm talking about in total. Okay, I have given a lot of examples in the previous video, so here I'm just quickly refreshing. So that is why I cannot quote examples, because otherwise this video will become too long. Okay, so variable cost in total, it will vary directly. Directly mean to say, if you will increase the production, total variable cost will go up. If you will decrease the production, total variable cost will go down. So this is what is called directly and proportionally. Okay, but variable cost per unit we assume remains constant in the short run. Per unit remain constant. Then guys, we have a fixed cost in total. Okay, fixed cost first. What is the fixed cost? These are those costs which remain constant regardless of the production. Okay, for example, rent, even you have 100,000 units of production, even you have a 0 unit of production, so this will remain constant. And fixed cost in total remain constant in short run. Okay, in short run means in short time period it will remain constant. For example, if you are paying rent 1,000, so it will be 1,000 maximum for 1 year. But fixed cost per unit, whenever you want to divide the fixed cost into per unit, so of course if your production will goes up, fixed cost per unit will go down. Okay, if you will decrease the production, fixed cost per unit will go up. Okay, so this is what is called fixed cost per unit. Varies indirectly. Indirectly means if you will increase the production, fixed cost per unit will go down. Okay, so with activity level. So this is what is fixed cost. Then guys, here we have a one more important definition, and then we will jump to the costing method. So this is the one definition which is called product cost. Product cost is also called inventoriable cost. Okay, and product cost, I mean in general, I'm explaining first. Product costs are capitalized as a part of finished goods inventory. Like this will be the part of the cost of the product, and eventually or ultimately what we will do, so these costs will become the component of cost of goods sold. Like even the product is sold, it will be the part of cost of goods sold. If product is unsold, so still it will be the part of cost of goods sold, because it will be the part of closing inventory. Okay, such costs include what? It might include direct material, direct labor, it might include production overhead, but depending upon the costing method, which costing method you are using. Then guys, we have a period cost. Period cost are those costs which we have to record as a expense, as incurred. They are not capitalized. I mean, so they are not going to be the part of the product, okay, of the finished product. Okay, and thus excluded from the cost of goods sold, because you are going to record as an expense. The theory is that the period costs are caused by passage of time and would occur even the production is zero. Okay, for example, rent cost, you can say, I'm just giving example, even there is a zero production, you have to incur these costs. But it will be more clear once we'll start the costing method. And here we go with the costing method, guys. So it's just an introduction. I'm going to tell you first the costing method. Here I'm going to talk about variable costing, which is also called marginal costing. And then we have a absorption costing. Absorption costing we will cover in the next video. So today my focus is on variable costing. So guys, under variable costing, we have to answer three questions, like what will be the product cost and what will be the period cost. Same way under the absorption costing, what will be the product cost and what will be the period cost. Okay, as per absorption, as per variable costing first, okay, the product cost, like the cost which should be inventorized, it should include only variable production cost. And in variable production cost, if you remember, I told you total cost can be divided into production and non-production. In production, we have a three category. We have direct material, we have direct labor, we have overheads. I told you direct material is variable cost, direct labor is variable cost, and overhead could be variable or fixed. Okay. So, and non-production could include selling and selling and marketing cost, and this could be variable and fixed also, and it includes also administration cost, which is fixed cost. Now, guys, when we say product cost under variable costing, so only we have to take variable production cost. Okay, and variable production, there are three costs, which is direct material, direct labor, and variable overhead. So these costs will be inventorized. I mean, so these costs will be the part of inventory. So now if you look what is left, so left is fixed cost and selling and administration cost. So selling and administration cost and fixed overhead cost will be treated as fixed overhead. All selling, all administration are treated as period cost. But because selling cost could be variable and fixed, and administration costs are fixed, so this variable cost have presentation difference, but it is period cost. Okay, presentation I will show you where to present under variable costing. But when it comes to, guys, when it comes to absorption costing, under absorption costing, what will be the product cost? So full production means say all these four is going to be the part of the product, which will include direct material, direct labor, variable overhead, and fixed overhead. And all non-production cost is going to be the part of period cost, which includes all selling and all administration. If you will look, what is the difference? Difference is, guys, all costing methods are same, but the point is here the difference is fixed overhead. This fixed production overhead is the part of product cost under absorption costing, and it is going to be the part of period cost under variable costing. Okay, guys, it is going to be the part of period cost. This is the difference. Now we have a few theoretical points, and then we will move to the calculation. Okay, so here, guys, please remember variable costing is only used for internal reporting purpose. It is not allowed by IFRS or GAAP for external reporting. And here under variable costing, we will measure our profit in terms of contribution margin, which I will show you how to get it, and net income. Okay, but net income, I mean say operating income. But on the other hand, absorption costing is used for external reporting because it is allowed by IFRS and GAAP. Okay, and here the profit is measured in terms of gross profit and net income. Okay, guys, so here we go. I'm going to show you first just shortcut presentation, then we will start the calculation of the product cost and how to prepare the income statement. Guys, here I'm just talking about, because it's just an introduction, I'm telling you about the variable costing and absorption costing. Please remember the accounting, these 3 points are really important. Accounting for variable production cost. Variable production cost include what? It includes direct material, direct labor, and variable production overhead. And fixed selling and administration expense. Fixed is identical regardless whatever method you are using. So what is the difference? The difference lies in varying treatment of fixed production cost, because fixed production cost was the product cost under absorption, and it is going to be the period cost under variable costing. And there is also one more difference, that is the presentation of variable selling and administration expense, because these variable selling and administration expense are going to be the part of period cost under absorption costing, and these are going to be the part of marginal cost of sale under variable costing. I will show you, don't you worry. Okay, so this is how it will look like that. If you look at here, this is shortcut of income statement. Otherwise, I will of course tell you detailed. So here just an overview. Under absorption costing, what you will do, you will write sale minus cost of goods sold. And in cost of goods sold, you have to take full production cost, which might include direct material, labor, variable overhead, and fixed overhead. This is called your cost of goods sold. From the sale, if you will subtract cost of goods sold, this is called your gross margin. And from there, you have to subtract total selling and administration expense, either variable or fixed. I'm using word variable plus fixed, all. So this is going to be your operating income. But on the other hand, variable costing, see what is the presentation difference. First, you will write the sale. From sale, you will subtract variable expenses. See, variable mean to say direct material, direct labor, variable overhead. and variable selling and administration expense. Guys, these three are called production variable cost, and this is called your non-production. But when you subtract all variable cost, this is called your contribution margin. Like if you want to calculate manufacturing contribution margin, you can say it's a kind of profit which are available to cover the fixed cost. Okay, there are two words. If I'm saying contribution, if they are saying manufacturing contribution margin, so then manufacturing contribution margin, then what you should do, you should take sale minus only manufacturing variable cost. I would say these three. Okay, but when they say contribution margin is general term, bigger term, then what you should do, you should say sales less all variable cost. All mean to say all, even it's relevant to production, even it's relevant to non-production. So that is called contribution margin. So we reach to the contribution margin, then you will subtract what? Fixed expense, fixed overhead from the production, and fixed selling and administration expense. This is going to be your operating income. Okay, guys. So this was the just introduction type. So now let's have a look, guys, how you will calculate the cost. So here we go, guys. I have already told you these things. So guys, here question number 1, how to calculate the product cost. I mean, it's a cost of one unit by using variable costing or marginal costing. I mean to say, not absorption. It's a variable costing we are going to discuss. Okay. So guys, as I told you, in the product cost, so three costs will be the part of product cost: direct material, direct labor, and variable overhead. This is going to be the part of product. Now, how you will write direct material? So you need to write kg per unit. For example, for one chair, let's assume for one chair, maybe you need 10 kg of material. So you will take kg per unit. Let's assume 10 kg times price per kg. And I'm assuming price per kg is $5. So if you will multiply quantity with the price, you will get cost of material. Then you have to write here direct labor cost. Labor cost, how you will write? Labor hours per unit. It means, let's assume, to produce one chair, we need 5 labor hours. And these hours we have to multiply with the rate per hour. And let's assume rate per hour is $15, which we are paying to the labor. So 5 times 15, it's going to be 75. Okay. And then, guys, for example, we have to add a variable overhead. How? I'm assuming variable overhead could be based on labor hours, or maybe it could be based on machine hours, whatever base is given. These bases we will discuss in future with the absorption, but just assume, I'm assuming here our variable overhead are based on labor hours. We need to take labor hours per unit, which are 5 as above we have taken. Just you will multiply variable overhead rate per hour. So mostly it will be provided in the question, variable overhead rate per hour. So just multiply with that. Let's assume it is $8. If you will multiply 5 times 8, you will get 40. So if you will add these three costs, guys, okay, these three costs, what you will get? You will get product cost by using variable costing. I hope it is clear. Now, guys, what are the period cost? I told you period cost. What will be the period cost under variable costing? It will include fixed overhead, all selling cost, and all administration cost. But I told you variable selling cost have the presentation difference under variable costing. And now I'm going to show you how you will prepare the income statement under variable costing. Then we will practice a couple of questions and we will do some analysis also. Guys, here we have here. We have here income statement first. We are going to talk about income statement now format. Actually, we are going to discuss question number 3, how to prepare income statement by using variable costing. Guys, so we have to prepare 3 columns. This column is for description. This column is for internal amounts, I mean to say, and this is for the final amount. This is inner column. This is final column. Okay, guys. So first we have to write with the sale. How you need to write, how you will find the value of sale? You always need units sold times sale price of each unit. If you will multiply, you will get the sale value. So I'm assuming there is no sales return, so you will directly write into the final column. Okay. Then from the sale, you have to subtract what? You have to subtract cost of goods sold. And cost of goods sold, how you will calculate, guys? You need first opening inventory of finished goods, and I'm assuming it is given. If it is not given, I will tell you how to do it. Don't you worry. So let's assume so far it is given. Then you have to add here plus what? Variable production cost. Each word is really important. It's a variable and production cost. And guys, how you will do it? So you will take unit produced times product cost. Product cost just we have calculated above. If you remember, it was 165. You can just go and check it back. And product cost include what? Direct material, direct labor, and variable overhead. Okay, so this is how you will get the variable production cost. Sometimes he might give you directly direct material, direct labor, and variable overhead in total. Just put it the total of these here. Okay, if it is given per unit, take the product cost, multiply with the unit produced. Okay, less what you have to subtract, guys, closing inventory. Closing inventory would say the value of unsold inventory. And guys, please remember under variable costing, of course, closing inventories are valued at product cost, and product cost include again these three costs: direct material, direct labor, and variable overhead. And how you will calculate the closing inventory? You need unsold unit times product cost, which you have calculated above. This is how you will get the value of closing inventory. If unsold units are not given, guys, so you can calculate this way. You can take opening units plus production units minus what? Sold units. You will get unsold. Unsold means say ending units, closing inventory units. Okay, so once you will multiply, you will get what? Closing inventory value. So if I will plus minus these three value, these three, okay, these three, so this will give you what? This will give you I mean to say, this will give you cost of goods sold, but you have taken only manufacturing cost of goods sold. Okay, manufacturing cost you have included only. Okay, so from the sale value, because above you have a here sale value, from the sale value, if you will subtract cost of goods sold, so this will give you what? Manufacturing contribution margin. In short, what is manufacturing contribution margin? What you have done, actually you have taken sales. From the sale, you just have subtracted production variable cost. Production, not the non-production. Okay, from this manufacturing contribution margin, now you can subtract what? You have to subtract non-manufacturing variable cost. And non-manufacturing variable cost, I would say variable selling or marketing cost, because maybe in your exam he might give you per unit variable selling and marketing cost. You have to take per unit variable selling and marketing cost, just multiply with the units sold because these are selling costs. So you will get variable selling cost. From manufacturing contribution margin, if you will subtract variable, I mean say non-manufacturing variable cost, you will get what? You will get contribution margin. And what I told you, what is contribution margin? Contribution margin is equal to sale less all variable cost. Okay, guys. Then you have to subtract all fixed cost. All fixed, I'm using word, it means it should include both production and non-production. Non-production means say selling and administration, all fixed and including production. Once you will subtract, you will reach to the operating income. This is how you will prepare the income statement. Okay, guys. So you can just repeat it one more time. You can just see by yourself now, because I have explained this. Now, guys, here we have here few points which you should remember. I'm going to talk about principles, because then I will do some questions to understand. Okay, so we are talking about main principles for variable costing and marginal costing. So point number one, it's really important. Here I told you period fixed costs are the same, because I told you fixed cost we treat as the period cost for any volume of the sale and production. Even your sale or production is goes up or goes down, so these costs will never change, provided that the level of activity is within the relevant range. This is the assumption. What is the relevant range we discussed last time? Okay, but just remember fixed cost in short run, it's not going to change. Okay, therefore by selling an extra item, like if you will sell one extra item of the product or services, the following will happen. What will happen, guys? Number one, your revenue, I mean sale, will increase by the sale value of the items sold. Your revenue will increase. Second is what? Second point, your cost will increase by the variable cost per unit. Like the variable cost, like your cost will change only with the variable cost per unit. And third is what? Your profit will increase by the amount of contribution earned. And I told you contribution, how it is, how you got contribution: sale less all variable cost. So if you will subtract, you will get what? Contribution. So when you sell one extra unit, your sale will also increase, your variable cost will also increase with that unit, and your contribution will also increase. And point number 3 is what? Similarly, if the volume of sale falls by 1 unit, the profit will fall. Okay, by your sale will fall and your variable cost will also fall. Okay, so this is what is the point. And the third point is what, guys? You should remember all these points because these are really important in order to understand. Point number 3, the profit measurement should therefore be based on analysis of the total contribution, because here we measure the profit in terms of the contribution. Why? This is the logic. Since fixed costs related to the period of time and do not change with the increase or decrease in the sales volume. Like even you will change the sales or the production, these fixed costs are not going to change in total. So that is why it is misleading to charge. What is misleading? It is the misleading to charge unit of sale with the share of fixed cost. Like you should, it means if fixed cost is not changing, this is the logic of the variable costing. If fixed costs are not going to change, so why to charge to the product? So this is what is the point. And the point number last is what? Whenever you want to value the closing inventory, and I told you how you got the closing inventory, you need unsold units times product cost. And for the product cost, I told you 3 costs will be included. Which 3 costs, guys? Direct material, direct labor, and variable overhead. Okay, so this is going to be the part of closing inventory. Okay, guys. And then here we have a small question. Let's practice small example, because there are 3 years data, year 1, 2, 3. I will produce only the calculation for year 2. Year 1 and year 3 you can just do by yourself. Solution is there, guys. So just we will produce the income statement by using variable costing. So here, guys, we have here production in units. In year 1 we have produced 40,000, in year 2 50,000, in year 3 production is 0. Sales in unit, in year 1 we have sold 30,000, in year 2 30, in year 3 30. So by the way, sales is the same in units, sale is same. Ending inventory, it's given here. For example, in year 1 we have a 10,000, because your production is 40, sale is 30, it means 10,000 is unsold. And in year 2 your production is 50, your sale is 30, but ending units are 30,000. How? Because in year 2 you have opening units which are coming from last year, which is 10,000, plus you have produced how much? 50,000. So total available are 60,000. From 60,000 you sold how much? Only 30,000. If you will subtract minus sold, you will get what? Unsold. So unsold are how much? 30,000. Okay, guys, unsold is 30,000. So it is given here, by the way, directly. So in year 3 you don't have any production, but you have sold 30,000, because this is going to be the opening for next year and you are going to sell these. Okay, and you don't have any closing inventory. Now, guys, here he told you what? Units sale price, we have a $1, and here we have a unit variable cost of 0.5. It's a variable production cost. We have a fixed manufacturing cost is 4,000 per year. We have variable selling and advertisement cost is $0.03 per unit, and we have a fixed selling and administration expense is 1,000. This is for sure is the period cost. Okay, now, guys, we have to produce the income statement. So I'm going to produce the income statement for year 2 only. Year 1 and 3 you can do by yourself, take as an assignment. Okay, so, guys, how you will do it? First of all, you need to write sale for year 2. And how you will write the sale? You have to take unit sold in year 2 is 30,000. Sale price is $1, so you will get sale of 30,000. Okay, then from there you have to subtract cost of goods sold, and that should include what? Beginning inventory. Beginning inventory, and we are talking about year 2. Beginning inventory means a closing inventory of year 1 will be the beginning of year 2, and inventory is valued at only variable production cost, which is 0.5, and closing inventory of year 1 is 10,000. If you will take 10,000, okay, times 0.5, which is variable production cost, it means 5,000 was the closing inventory of year 1, which is going to be the beginning inventory of year 2. We got beginning. Okay, then, guys, you have to add variable manufacturing cost. How you will get this value? Variable manufacturing cost means that you have to take units produced. Production is 50,000 units produced, multiplied by variable cost of the production, which is 0.5. So you will get 25,000. Okay, Then you have to subtract closing inventory, and closing inventory, how you will get for year 2, you have to take unsold units of year 2, which is 30, multiply by again product cost or the production cost. So if you will multiply 30,000 times 50, you will get what? You will get $15,000 as ending inventory. I have got, guys, you got this value. Okay, now if you will take opening inventory plus production cost minus closing inventory, this is called your variable cost of goods sold. And from the sale 30,000, if I will subtract this variable cost of goods sold, it is called what? It is called manufacturing contribution margin. And from manufacturing contribution margin, if you want to subtract variable selling and administration expense, and how you will get selling and administration? Because you have to take units sold, because it's a selling variable cost. So you have to take units sold. Units sold are 30,000. Okay, guys, times variable cost. This is the unit variable cost. So you will get 900. I guess it will be same 900. You can check on the calculator. Then, guys, if you will take sale less all variable cost, all variable, this is called your contribution margin. Okay, so contribution margin is 14,100. And from there, guys, you have to subtract all fixed, and there are two fixed costs. Which two fixed costs? Fixed manufacturing and fixed selling. It is given in the question. 4,000 and 1,000. You can just cross check. So we have here 4,000 is the manufacturing, 1,000 is the non-manufacturing. So total is fixed cost is 5,000. If you will subtract 5, you will get what? Operating income. Okay, so guys, for year 1 and 2, you can do by, for year 1 and 3, you can do by yourself. Okay, now here we have a conclusion. What is the conclusion? So these are the points which you should remember, guys. First point is what? Profit per unit varies. Profit, I mean, say I'm talking about this profit. Like when you will divide this profit per unit, this profit over the number of units sold, So it should vary, but here it will be the same in this example. Why? Because every year we sold every year 30,000 units. So that is why here your profit per unit is going to be constant. But ideally, if your sale is changing, profit per unit will change. It will change. Okay. Then, guys, we have a second point which you should remember also. Point number 2, contribution per unit. How you will get the contribution per unit? First of all, just how to calculate contribution per unit. You should take this contribution margin every year divided by units sold. You will get contribution per unit. Okay, like if you will divide this contribution, I mean say total contribution, okay, with the unit sold, okay, so you will get per unit. So this per unit contribution is always constant. We are assuming in the short run, it is what? It is going to be constant. It's not going to be changed. Okay, third point is what? Third one, you should remember this node actually. If your total contribution, I told you the total contribution means this one. I'm talking about this value. This is your total contribution every year. If this total contribution is greater than fixed cost, it will be your profit. If total contribution is less than total fixed cost, it is going to be your loss. If total contribution is equal to fixed cost, it is going to be a break-even point, right? Yes. Okay. So here we have now, guys, last point I want to tell you here. It's really important point, because this example, I want to tell you how shortcut we can calculate the total profit by selling multi products. So here, guys, we have two products. Let's assume we have a product, for example, M, okay, and we have a product S, let's assume. So here we have a data. We have here opening inventory nil and nil for both product. Production units, we have 15,000, 6,000. This is production. Units sold are 10,000 and 5,000. And here we have a unit sale price, $20, $30 for each product. And guys, if you look what it's written here, unit cost. This is actually unit cost. Now what? Material, labor, variable production overhead, variable sales overhead, fixed cost for the month. Okay, actually these are the variable cost. Here variable cost is going to be 12 and 16. And here variable costs are going to be 20. Okay, if you want to calculate the contribution, what is the sale price? Sale price is 20 minus variable cost is 16. It is going to be $4 contribution. And here $30 is the sale price minus variable cost is 20, so contribution is going to be $10. Okay, and here guys you are provided with the fixed cost information for the month. And what is the fixed cost? Fixed costs are 40,000 plus 15 plus 25, so total is going to be 80,000, because these are three fixed costs: production cost, administration cost, and selling and distribution. So what is the requirement, guys? We have a small question to do it, but look at the requirement. Using marginal costing, I mean, say variable costing principle, we have to calculate the profit in the month of April, and for the both product you have to calculate. And guys, how you can do it? Don't forget, you don't need to solve in detail, because I'm just trying to show how you can solve MCQs quickly. So what you need to do, guys, here simply you need to take what? First you need to calculate revenue. How you will calculate revenue, guys, for the both product? I'm doing here simply. Don't forget, guys, for the this is product M and this is product S. For the M, what was the contribution for the M? Sale price minus variable cost contribution was 4. So what you can do here, unit sold are 10,000 multiplied by $4, so total is going to be 40,000. And for the S, what is the contribution? This is the sale price, this is the variable cost, contribution is 10. 10 times unit sold are 5,000, so 5,000 times 10, it's going to be 50,000. So your total contribution is going to be 90,000. This is for the both product. This is going to be total contribution. And from the total contribution, if you will subtract fixed cost, which are 80,000, it's given in the question. So this is going to be your profit or operating income. Okay, in shortcut. Okay, guys. So here is the solution. If you want to see with more clarity. So here we have contribution for M, contribution for S, total contribution. We have a minus fixed cost. We got a profit. Okay. Now we have another requirement. Please focus here. Calculate the profit if sales had been 15,000 units of M and 6,000 units of S. Guys, you know what we learned? I told you contribution per unit will not change, and contribution for M contribution was 4. You will just multiply 15,000 with $4, and contribution for S was 10. So you will multiply 6,000 units with the 10, because these are new units. Okay. So what you will do here, please, and fixed costs are not going to change. So guys, here you have to calculate contribution for M, 15,000 unit multiplied by contribution per unit, it is 60,000. Contribution for S, okay, how many units? 6,000 units time contribution per unit was 10, it is 60,000. So total contribution is going to be 120,000. From there you will subtract fixed cost of 80, you will get profit of 40,000. I hope, guys, it is clear. Maybe this video is very long. So thank you so much. See you in the next video. Bye bye.